Let's get right into it. Welcome, everyone, to today's Explainer. It's August 22nd, 2026, and we are unpacking the story of BHP Group Limited. Now, if you track commodities at all, you already know BHP is an absolute giant. But what's really fascinating right now is their massive transformation. We aren't just looking at a traditional miner anymore. They've totally pivoted to become a true powerhouse in the global energy transition. Here's our roadmap for the breakdown. We'll be looking at FY2026 financials, the new strategy, the growth engines, core operations, the macro outlook, and finally, the verdict. Section 1, FY 2026 financials, record profits and dividends. So the numbers from their August 18th release are frankly mind-blowing. We're talking $58.8 billion in revenue. That's a 15% jump year over year. And underlying EBITDA, right around $33 billion. Those are the kinds of numbers that literally make the market stop and stare. And for all the income-focused investors out there, this is why BHP stays on your radar. $1.72 per share. That payout brings the total dividend to a staggering $8.7 billion. To give you some perspective, this is BHP's biggest full-year dividend in 4 years. It's a massive reward for shareholders, and it signals serious financial health. Now, check out this historic shift. For the very first time in BHP's entire history, copper has taken the crown. It's now the absolute majority of their earnings, driving 54% of the group's underlying EBITDA. They pumped out around 2 million tons for the second year in a row. So they aren't just mining copper anymore, they are dominating it as the largest producer on the planet. To really grasp the sheer scale of their copper business, just look at this figure. $18 billion. That's the record EBITDA from copper alone. And get this, it comes with an unbelievable 70% margin. Just let that sink in for a second. That $18 billion is actually bigger than the entire market cap of a lot of mid-tier mining companies. It's just an absolute cash machine. Moving on to Section 2, the new strategy, a new era. BHP has essentially flipped the script under brand new leadership. Brandon Craig took over as CEO from Mike Henry on July 1st, 2026, and he wasted absolutely no time laying down a highly disciplined playbook for investors. Craig's whole game plan rests on 3 core pillars. First up, organic growth over acquisitions. He pointed out a wild metric. Building new copper capacity is actually about 5 times cheaper than buying existing assets. I mean, why overpay for someone else's mine when you can just build it better yourself, right? Pillar 2 is operational excellence, pushed through the BHP operating system. And Pillar 3 is strict, unrelenting discipline in capital allocation. They are absolutely not chasing growth at any cost. Which brings us to Section 3, the growth engines, copper and potash. If they're focusing so heavily on organic growth, where exactly are they placing their massive bets for the future? Well, it boils down to 2 heavy-hitting growth engines. Engine 1 is copper, primarily in the Americas. We're talking assets like Escondida in Chile, the biggest copper mine in the world, plus Spence and the long-term Vicuña project in Argentina. The tailwind here is huge. Global copper demand is set to skyrocket from 32 million tons today to over 50 million tons by 2050, driven entirely by electrification and renewables. Remember, an EV uses up to 4 times more copper than a gas car. Then you've got Engine 2, potash in Canada, anchored by the Jansen project. Driven by global agricultural demands, potash is projected to hit 100 million tons by 2050. These are the twin megatrends BHP is riding. But hey, it hasn't all been smooth sailing. The Jansen project hit a bit of a speed bump. Stage 1 is actually doing great. It's 84% complete for a mid-2027 launch. But Stage 2, capital costs jumped up to $6.9 billion. That triggered a $2.3 billion non-cash impairment, which did take a bite out of their total attributable profit this year. Now, the long-term economics for Jansen are still fantastic, projecting around $1 billion in EBITDA per stage. But this is a serious reality check on the sheer cost of these mega projects. Section 4, core operations, cash and challenges. So to fund these multi-billion-dollar bets, BHP leans heavily on its traditional Aussie pillars. These are the operations that print the cash, but they definitely come with their own headaches. It's really a tale of 2 entirely different divisions. On one hand, West Australia iron ore just crushed it, a record 265 million tons, holding the title of lowest cost major producer for 7 years straight. Just a massive cash cow. On the other hand, you have Queensland Coal. CEO Brendan Craig didn't mince words. He called their royalty regime unsustainable. so they aren't dumping any new major capital into it. But he also completely shut down the sale rumors. They're just going to manage the coal division for cash to fuel their growth elsewhere. Before we jump ahead, we do need to address operational safety. The company is actively investigating a recent contractor fatality at the Peak Downs mine. Craig was incredibly direct about this, stating, "The only acceptable number is 0. Mining is tough, high-risk work, and beyond the human tragedy, a rock-solid safety record is absolutely foundational to the stability of the entire business." Section 5, Macro Outlook, Supply, and Demand. Let's zoom out a bit. To really get BHP, you have to look at the global board. The macro environment dictates commodity prices, and that directly drives BHP's bottom line. From a demand perspective, management is locked onto 2 heavyweights. First, China. Sure, their historical explosive growth is cooling a bit, but their massive policy support for electrification and grid upgrades is a huge, ongoing tailwind for copper. Then there's India. They're on track to be the world's 4th largest economy by 2025. With rapid urbanization and rising living standards, India is a massive long-term catalyst for exactly what BHP is digging out of the ground. Now, the flip side is supply, and it is getting ridiculously hard to build new mines. We're talking lower ore grades, way stricter environmental regulations, permitting timelines that drag on for years, and development costs going through the roof. Honestly, this supply-demand squeeze is a huge structural advantage for BHP. It basically puts a floor under long-term prices. If nobody can easily build a competing mine, BHP's existing copper becomes infinitely more valuable. Which takes us to Section 6, the verdict, buy or hold. We've talked record profits, stellar strategy, and unbeatable macro tailwinds. Sounds flawless, right? But here's the plot twist. What does all of this actually mean for the stock price today? Well, BHP's stock has been on an absolute tear, rallying over 63% year-to-date, trading right around $97, which is near its 52-week high. But when you compare that to the average analyst's 12-month price target sitting way down at $74.07, a stark contrast emerges. That massive gap tells us that all this amazing news we just covered, it might already be fully baked into the current price. And this metric explains the caution perfectly. 24.23. That's BHP's trailing PE ratio with a forward PE of 18.35. For a cyclical miner, that is a very steep premium compared to the broader market. It's exactly why major players like Berenberg Bank and RBC Capital are slapping a hold rating on it right now. They love the quality of the company, but they aren't loving the price tag. So it boils down to this. The stock appears to be priced for perfection. If you already own shares, BHP is a phenomenal hold, paying out a massive dividend. But if you're a new investor looking to jump in today, your near-term upside looks pretty capped. If a growth project gets delayed or copper prices dip even slightly, you're looking at a real risk for a near-term correction. Which leaves us with a final question to chew on. We know the world desperately needs BHP's copper and potash to power the energy transition and feed a growing population. But with valuations stretched to the max, is patience the ultimate commodity for an investor right now? Do you wait for a pullback, or do you just pay the premium for a dominant player? It's a fantastic dilemma to watch unfold. Thanks so much for joining me for this explainer. Keep learning, and I'll see you in the next one.